प्रेजेंटेड बाय ईबिक्स कैश। हर खुशी के लिए काफी है।
Hello and welcome. You're with us here on Business Today. I'm Abha Bakaya. Here are the headlines tonight. Carnage on Dalal Street. Sensex crashes 1,545 points on weak global cues. Nifty ends below 17,200. All sectors in the red. IT, metal, realty worst hit. Investors lose nearly 20 lakh crores in 5 sessions. As market turns negative for 2022, we'll get you an exclusive conversation with Ridham Desai of Morgan Stanley on the sharp sell-off and what investors should do in this bear market. Steady Q3 for Axis Bank. Net profit jumps over 200% to 3,614 crore rupees. Net interest income also jumps 17%. Net NPAs fall 17 basis points Q-on-Q. Food and grocery delivery platform Swiggy raises $700 million at a valuation of $10.7 billion. Swiggy is now the fourth privately held firm valued at over $10 billion after Paytm, Oyo and Byju's. US and UK withdraw families of diplomats from Ukraine over fears of Russian invasion. NATO sends ships, fighter jets to Eastern Europe as Russia continues troop build-up near Ukraine. A sea of red on Dalal Street today, the sell-off continuing to a fifth session now. Sensex logging its biggest daily fall since November 2021, sinking over 1,500 points. Nifty also posting its worst day in 2 months, down 6% now in just the past 5 days. The Nifty declined over 460 points today. All sectoral indices in the red with cuts in the range of 2 to 6%. Losses in IT, auto, metal, pharma, consumer shares, all pulling the headline indices lower. While all sectoral indices bled, stocks of new age tech companies were the worst hit. Paytm, Nykaa, Zomato all hitting new 52-week lows. With the carnage on Dalal Street, investors have lost about 20 lakh crore rupees. So why did we witness this Monday mayhem on Dalal Street? Nervous investors entered the pre-budget week low on confidence as they awaited the outcome of a 2-day Fed policy meet. Rising crude prices, geopolitical tension, ongoing FI selling, some of the reasons that are keeping the markets under pressure. Joining us now, our global business editor, Udayan Mukherjee. Udayan, what a day for the markets. In fact, what have we been seeing the last few days now? It's been a rapid sell-off. We're now in the negative for 2022. Just when we thought, we'd kick-started the year on a really positive, upbeat note.
Abha, we were speaking about it last week. You will recall that I was saying that there's every possibility that a global bout of volatility will jolt us, and that was the risk really, not so much Omicron or the budget which we were discussing. And it's been global, this massive correction which has set in. It started actually with the Nasdaq a few weeks ago, and that was the first sign that the US market was waking up to the possibility that the Fed might have to be more aggressive and more urgent in interest rate hikes, and that's exactly what has happened. So, the Dow has corrected, but the correction in the expensive stocks or the fancy growth stocks in the Nasdaq has been absolutely brutal. So I think some of that is flowing across here. We've seen some FII outflows, but I think India will also be hurt by this round of global volatility. Now, how deep this becomes, we'll see in the next few days, because it also depends on how badly global markets do. But I think we've pulled back from the brink of that 18,500, which was the previous peak for the Nifty. And we've come very quickly down to the 17,000 levels. Now, we still have a cushion of 500-600 points, because I think the last time the market fell to around 16,400 on thereabouts on the Nifty. And from there, we saw that very smart 1,700-1,800 point rally. So we have some room to go back and test that level, and we are not hitting those bottoms immediately. But I think in the next few days, that's the level to keep watching, that broadly that 16,500 level, on whether the market manages to hold that and bounce back and stabilize from that. But I think we are in for a few rocky days. Ridham, good to see you on the show again. It's quite a day to have you on. Do you think it's going to turn out to be one of those years where the union budget becomes a sideshow and all the attention is hogged by volatility in global markets?
Well, yeah, potentially it can be. I mean, we've been anticipating volatility around the Fed's exit, so it's come, and that's appropriate. It doesn't mean the bull market is over. We had a similar situation in 03-04 when the Fed exited, and there was a lot of volatility. This is not 2013. I think the 04-08 cycle, as we've discussed in the past, is more relevant to this one. But of course, we'll see. The budget, yeah, I think it can still bring relevant things to the table. India has got a fair bit of idiosyncratic factors that are going for it. And amongst them is a new profit cycle. So I would still be keenly watching the budget. I mean, it is never a sideshow. Its impact on the market, though, at least short-term performance, has been waning over the past 3 decades. And even the volatility on budget day, which used to be quite intense in the 90s and the first decade of this millennium, that also has reduced a fair bit. And maybe this is because budgets have evolved. It no longer has the ingredient of indirect taxes in it. Direct taxes are far more stable. The fine print has kind of gone away. But the overall strategic thrust of the budget, I think, is still relevant. It's very relevant to how this bull market shapes up in the coming months.
We'll talk a lot about that, Ridham, but first a little bit more about this global volatility. I mean, how intense do you expect it to be? Because, I mean, the Fed seems to be ratcheting up its intensity and its urgency quite a bit in the last few pronouncements. Do you expect, I mean, a fair amount of fall has already happened in the high growth areas in the US, the expensive stocks, the technology stocks, but do you see much more ahead in the next few months?
See, I think, Udayan, I would be actually quite encouraged that the Fed has expressed this urgency, because the risk, one of the risks, and I think we discussed this on the previous show, one of the risks to the bull market was that the Fed fell behind inflation. Markets hate a Fed or a central bank that's behind inflation. It applies to the RBI as well. And the risk was that given the pandemic, central banks were taking less chances. They were being, erring on the side of dovishness, and inflation was, building up. So the fact that the Fed is a bit more urgent, aside from this volatility, is actually good news for the growth story ahead. And if the Fed, does keeps its nose ahead of inflation, the markets will actually like it eventually. This is, par for the course. We've been in an environment of very low interest rates for several quarters now. And if interest rates are going up, then as you very rightly point out, high growth stocks, which are trading at high multiples, are the ones that take it on the chin. The market is discriminating between those and the rest, where multiples may not be as rich. So the headline indices have not corrected as much as what has happened underneath. And I think that will probably remain the narrative for some time. And then you get some sort of capitulation, which I think then causes indices to bottom out. So that could be the path ahead. We still need to see what the Fed does and how exactly it pans out, and how much market prices in before the Fed event.
Okay. Back to the budget, Ridham. I mean, there are two views that the finance minister might actually take another year before she gets back to the path of fiscal consolidation, and therefore peg the coming year's fiscal deficit to say around 6.5%. There's another view that now that tax collections are so buoyant, she will now get back very urgently to the path of fiscal consolidation, which she deserted for a couple of years because of the pandemic, and therefore the fiscal deficit projection is even closer to 6%. Which one would the market like more? Which of these two options would the market like more, and what kind of stocks would come to the fore in the event of each of these outcomes?
So I think, Udayan, I would like to call it as a credible fiscal consolidation. The path is what the market will like. So the 6% number, I think, will be welcomed by the market, so far as it's backed by credible estimates. We are in one of those rare years, and actually we have to go all the way back to 2006, where government had the luxury of choosing between fiscal consolidation and spending because of buoyancy in tax revenues. So it's been a while since India has had buoyancy in tax revenues, and that's a very good thing for the markets as well, because it allows the government to make a choice. Let's boost growth further. Let's spend more money and delay fiscal consolidation for a year, or let's focus on getting to the path of normalization by consolidating the fisc with some credible numbers. I think that's the latter which the market will celebrate, because when you're spending in a growth recovery, then the risk is you invite inflation. Also, what that does, Udyan, is it actually restrains the RBI. Remember, the RBI also needs to exit, and we're expecting the RBI to hike the reverse repo rate in February and then follow it up with successive rate hikes. The Fed is on a hiking path, so the RBI can't stay far too behind. I mean, no doubt India's macro stability is a lot better than it used to be. But even then, the RBI can't stay too far behind the Fed. And if the government pursues a path which is a little bit more on the fiscal expansion side, then it does create a bit of a problem for the RBI. Now, on your second question, which I think is very interesting, is what rates? And I think this all actually points to the probability that financials deliver stellar outperformance. So the RBI is likely raising rates, which means the short end goes up, which means financials have higher yields on their assets. The liabilities reprice a lot later, so their margins expand. I reckon that after the recovery in economic activity, credit growth will follow. And we can all opine that credit costs may have peaked because profits are recovering now. So this is really, a situation which financials will really love. So I would expect that sector, which has not done so well. And you've been in the market very long, Udyan, and you know that bull markets in India have rarely been created without financials. In fact, it's hard to remember one. We have to go all the way back to the mid-90s when consumer staples drove it. This has been a rare bull market which has not been built on outperformance by financials. So I think 2022 looks like to be a year of financials. Now, your second situation where the government chooses to spend money and not consolidate the fisc, I think will probably play into the hands of the consumer stocks. So that means more spending by the government, which I reckon will be in rural and infrastructure. So industrials and consumer stocks, I think, could do well. So those would be, how the market would react. The market will probably like the first scenario more than the second.
All right. Ridham, just want to get a take from you also on, the global bond indices. There's been a little bit of chatter around that and possibly an inclusion coming in on that front. Is that something the market is expecting to hear in the budget?
So I don't think the market is expecting it. It doesn't look like it's priced into the bond markets or the equity markets. It's something that we are expecting. And what exactly are we expecting? We're expecting clarification on the taxation of income that fixed income investors coming into the fully accessible route bonds, FAR in short, that's the acronym for fully accessible route bonds, have to pay. So essentially, it's an exemption from filing returns because Euroclear has promised the government that they will do the needful on behalf of these investors. And if the government does go to that extent, then I think it will set the stage for an inclusion of India into global bond indices in a couple of quarters from now. So maybe the third quarter of this year. Okay. Now that entails massive inflows. Just the passive flows that could come in the subsequent 12 months could be of the magnitude of $20 billion. It doesn't count for the active money that comes in. India, for the first time, will actually attract that type of inflow. And there will be a global yield profile that India will have. It will take the burden of financing the government's deficit partly away from domestic banks. So they will feel a release of liquidity, which they can then put into work into the credit market, which essentially means private investments get crowded in. and you also get a bid on the 10 years, so the yield curve flattens. So all these are really massive implications for India's growth and for India's BOP. So if this clarification comes, I think this may be the biggest takeaway from the budget.
Ridham, I also wanted to check on the LTCG. The market is rife with buzz that it might be hiked to 15%, and that's spooking investors.
Yeah, it was in the air last year as well, and it's in the air now. The introduction of long-term capital gains tax in 2018 was not such a, it was a successful experiment. The government has collected taxes. And, there is this opinion that long-term capital gains tax should be aligned with the other taxes in the country. My own view is that it's still early days. India still needs a growing pool of risk capital. We can't be continuously relying on global investors to provide that for us. That's what's happened over the past 30 years. We need to encourage further flows into equities. It's a very nascent story. If investors and one of the things that equities does is provide this lower taxation benefit, especially for those who are willing to hold it for the long run. So I would hope that this incentive stays. If the incentive goes away partly, yes, you're right, it will spook the market. It did in 2018, and it could again, especially the broad market, small and mid caps, could really get hurt in the short run.
Do watch the full interaction with Ridham Desai on businesstoday.in and Business Today's YouTube channel. Benchmark indices, Nifty and Sensex witnessed the worst fall in the last 2 months today. The carnage on Dalal Street affected all sectors as they ended the trading day in the red. IPOs of new age companies were amongst the worst hit. Shares of online food aggregator Zomato extending losses from last week and declining nearly 20%. Over the past month, Zomato's shares have fallen nearly 30%. Another D Street debutant, Paytm, hitting a lifetime low. Stock traded 55% lower from its all-time high and ended 4.6% lower at 916 rupees. Nykaa slipped by nearly 13% in trade at 1,745 rupees. Similarly, as you can see on your screen, other new listings like RateGain, Car Trade, Star Health, Paras Defense all falling by 7, 5 and 3-4% each. Moving on to earnings now, Yes Bank reported a 77% jump in profits year-on-year in the December quarter. The bank saw its asset quality improve sequentially in the quarter. Analysts expect the lender to benefit from the setup of its proposed asset reconstruction company.
We invited expression of interest from some of the stress asset players. We got interest from very large international stress asset players. And currently we are in the process of shortlisting. So I think by next month we would be able to finalize our partner in this. So we are trying to conclude the entire transaction by March end or maybe first quarter of the next financial year, if there is any delay. And then the entire NPA book of the bank would be shifted to the ARC. And the bank would be like a 0% NPA.
Asian Paints reported a mixed set of numbers. Inflationary trend in raw material prices impacting margins, while the company's profit tanked. Revenue saw some robust growth. Domestic decorative business registered a strong double-digit growth.
The volume growth is something which we are very buoyant about, and we've got an 18% volume growth and about a 26% value. When we look at margins, obviously the gross margins sequentially have gone up given the fact that we took 2 big price increases in Q3, one in November and one in December, amounting to about 15%. Overall, PBDIT margins are also up from the last quarter sequentially, and they have gone closer to about 19% overall to that extent. So therefore, what we are seeing is a very strong and positive trajectory with respect to how inflation had hit us overall in the first half of the year.
Biocon reported a strong set of numbers in the December quarter. The company saw growth across all verticals, leading to a rise in profit, but margins did take a bit of a hit.
One of the factors that has kind of muted margins this quarter is really a mark-to-market loss, which operationally should not be looked at, because this is a notional loss, a mark-to-market loss of 77 crores, which has really shrunk the margins a little bit. But if you actually remove that particular loss, then margins actually are at a very healthy level, 28%. So it's much stronger than last year.
While HDFC Life registered a 4.5% profit, the company missed estimates. The private insurer also logged a big decline in revenues.
Indian GAAP profits were impacted because of the excess mortality reserving that we did due to COVID claims. If you remember, in Q1, we started off with 700 crores. We increased it further. We have continued to increase. We made a further 55 crores in Q3, just as ample precaution in case Omicron rears its head in terms of elevated death claims. Not that we expect to, but just as ample precaution. So that has also impacted the profitability.
US stock futures slid Monday following the worst week for the S&P 500 since March 2020, as investors fretted about interest rate hikes ahead of the Fed Reserve meeting this week. Last week was a painful week for billionaires, as everything from e-commerce to cryptocurrencies to online gaming tumbled. World's top 5 tech billionaires shed a collective $67 billion in wealth this week. Jeff Bezos shed $20 billion from his fortune. Changpeng Zhao of Binance dropped $17.7 billion, while Mark Zuckerberg's wealth fell $10.4 billion. Elon Musk, the world's richest person, saw his net worth drop by $25.1 billion, or more than 9% last week. Food aggregator Swiggy announces a fundraise of $700 million in new funding led by Atlanta-headquartered Invesco. The round also saw participation from a host of new investors such as Baron Capital Group, Sumeru Venture, IIFL AMC, etc. With the new fundraise, the Bengaluru-based company has now reached a valuation of $10.7 billion. Ola Electric has raised $200 million from a clutch of investors, including Techne Private Ventures, Alpine Opportunity Fund, and Edelweiss. The company confirmed to business today. The fresh funding round values the company at $5 billion. Paytm's parent, 197 Communications, and NBFC Fullerton India announced a partnership. The deal will offer Paytm Postpaid a buy now, pay later scheme utilizing Fullerton's deep risk assessment capabilities and scale. The companies will expand offerings and include instant end-to-end digitally originated personal loans disbursed using Paytm's technology and Fullerton's presence. And that's all we have time for on the show today. Thanks for watching.